As the regular trading session on the Nasdaq has officially wrapped up for the week, Datavault AI Inc., trading under the ticker symbol DVLT, stands at a closing price of $0.4742 per share. This micro-cap data sciences and digital asset technology business finished the day flat, showing zero net percentage change relative to its previous session close, though the internal trading dynamics throughout the day painted a much more volatile picture of a company caught directly between massive fundamental promises and aggressive retail share dilution. When you see a stock trading under 50 cents, the immediate assumption by almost every participant utilizing a basic individual brokerage account or scanning the daily charts on their Robinhood app is that they are looking at a dying asset or a forgotten penny stock bleeding out into irrelevance. But the reality under the surface of Datavault AI tells a completely counterintuitive story. Because while the stock price screams distress, the company's operational pipeline is currently positioning it as a middleman for major global capital infrastructure. Just this month, the firm finalized a massive mutual services agreement with Perpetuals.com Limited to list over $328 million in real-world asset token programs on regulated European exchanges, a transaction modeled to bring in roughly $38 million in direct fee revenue for Datavault AI alone. This creates a fascinating tension because the everyday retail trader pulling up the Robinhood app or setting an alert on their SoFi Invest platform sees a stock down significantly from its 52-week highs, assuming bankruptcy risk, while institutional microcap hunters are watching a business attempt to bridge the gap between traditional physical commodities and digital sovereign networks. The disconnect between public perception and actual corporate restructuring here is immense, and understanding it requires looking past the cheap share price to see how the corporate identity itself has transformed. The consensus narrative holding the stock down is heavily anchored in its past failures when the company operated under the name WiSA Technologies, a business focused almost entirely on wireless audio engineering and sound over data patents that struggled consistently with liquidity, negative margins, and massive overhead. When the business pivoted, executing an asset purchase from Datavault Holdings and formally altering its name to Datavault AI Inc., the general market view was that management was simply chasing hot tech buzzwords to pump a flagging equity structure. But a deeper look at their active technology architecture shows they are attempting a legitimate shift towards secure data capitalization, financial vertical integration, and blockchain-verified credentialing layers. For the average individual looking for investment help or testing out self-investing strategies across modern interactive brokers platforms, microcaps like this present a structural paradox. On one hand, the business has aggressively diluted its equity base, recently issuing owner 109 million shares in a registered direct offering priced at 55 cents to raise near-term operational capital, a move that explains the intense downward price pressure and the current consolidation near the 42-cent support level. On the other hand, management has firmly reiterated its full-year revenue target of at least $200 million, which would mark an astronomical 400% growth rate compared to prior periods, supported by a reported pipeline of over $800 million in total asset tokenization contracts. This extreme divergence between a balance sheet that has historically burned through cash and a forward-looking pipeline that looks like an explosion of growth is precisely why the stock is experiencing such compressed defensive trading volumes as larger market participants adopt a strict wait-and-see posture. If we break down the immediate technical structure and recent trading volume patterns that have played out over the last few weeks, the stock has found itself trapped within a narrow, stubborn consolidation channel bounded by a floor at $0.42 and an immediate overhead resistance ceiling at $0.46 to $0.48. Trading volumes have noticeably dried up compared to the massive speculative surges seen during the initial name change announcement, a classic sign that the initial wave of retail momentum has rotated out, leaving the stock to be scrubbed by automated algorithms and patient accumulation strategies. What is driving this price stabilization is a constant battle between corporate funding needs and contract execution. For instance, when the company missed its first quarter earnings consensus estimates, posting a net loss per share of 9 cents against an expected loss of roughly 7 cents, short sellers immediately stepped on the equity, driving a nearly 5% drop in extended hours. This wider net loss was driven entirely by a heavy escalation in research and development costs, along with expanded sales initiatives required to bring their newer data security platforms to market. Yet institutional tracking data available on the Fidelity trading platform reveals that despite these elevated operating losses, the core product margins actually improved as the revenue mix began shifting towards software as a service subscription models rather than low-margin hardware components. When people use online investing tools or browse through standard investing sites to screen for tech opportunities, they often overlook these minor structural margin improvements because the headline net income figure remains deeply negative. This creates a localized pricing inefficiency, where the asset gets heavily penalized for spending capital on growth, even when that capital is being deployed to secure contracts that could completely erase the current deficit within a few fiscal quarters. Let's pause on the numbers for a second, because I want to get your read on how you approach this specific corner of the market. Comment below how many shares of Datavault AI you currently hold, or if you prefer to avoid microcap technology equities entirely due to the dilution risk. It is incredibly helpful to see how different people navigate these high-stakes setups. To fully understand why Datavault AI is sitting at this exact valuation, we have to look closely at what the underlying business actually does today. Headquartered out of Beaverton, Oregon, the company operates as a specialized data sciences entity that builds and sells proprietary systems designed to capture, secure, and monetize complex corporate data assets. Their technology stack features proprietary tools like Datavault, DataValue, and Datascore, which function alongside an intriguing acoustic division known as ADIO, a platform that handles secure data transmission using sound waves over wireless audio environments. Their primary business model relies on licensing this software to financial institutions, healthcare providers, and academic entities who require immutable, tamper-proof verification networks to track identity credentials or handle real-world financial token issuance. Essentially, they take a physical asset like a copper mine or a geothermal energy plant, build a digital tracking profile for it, and then partner with overseas exchanges to convert those profiles into tradable financial securities. This specific operational strategy is what led to their multi-million-dollar deal with Perpetuals.com, which is built to launch specialized programs like Gold Vault, targeting $150 million in issuance, alongside Coppercoin and Triton Geothermal. The revenue model here is highly front-loaded with onboarding fees, followed by long-term recurring maintenance costs, which is why management feels confident in their $200 million annualized run rate, despite having historical trailing 12-month revenues closer to $41 million. The legacy of the business, however, continues to act as an anchor on the stock's valuation metrics, because the firm spent over a decade operating as a semiconductor and wireless audio component supplier under its old identities. It carries structural debts and a historical track record of consistent capital raises that make traditional institutional wealth advisors using Schwab Intelligent Portfolios or conservative Fidelity mutual funds pass on the stock entirely. It does not fit the clean profile required for automated intelligent portfolio allocation or standard algorithmic equity funds, leaving the price discovery entirely up to active retail accounts and specialized microcap venture funds. Looking forward into the remaining quarters, the trajectory of Datavault AI will be dictated by a very distinct set of catalysts and downside structural risks. The immediate opportunity for a breakout above the current consolidation zone lies in the execution timeline of their commodity programs, specifically the scheduled third-quarter launch of Gold Vault and the structural spin-out of their acoustic sciences division into a standalone NASDAQ entity to be called API Media. If management successfully pulls off this corporate separation, distributing shares of the new media company directly to existing DVLT holders as a dividend, it could unlock significant hidden value from their legacy audio patents, while leaving the core parent company clean to operate purely as an enterprise software and digital asset network. Conversely, the primary risk that investors utilizing SoFi Active Investing or interactive self-investing platforms must account for is the ongoing operational cash burn. If the revenue recognition from these massive $308 million token pipelines face unexpected regulatory delays from international bodies like the Cyprus Securities and Exchange Commission, Datavault AI will likely be forced to tap capital markets once again, further diluting the existing share pool and delaying any clear path to true profitability. When you synthesize this entire narrative, the core conflict boils down to a clear contrast between what the broader market expects and what the underlying corporate reality is presenting. The market expects a typical sub-$1 tech stock to continue its patterns of high cash burn, frequent share offerings, and ultimate balance sheet decay. The emerging reality, however, shows a restructured company that has cleared its throat, shifted away from low-margin hardware production, secured major cross-border commercial service agreements, and established an ambitious but mathematically supported $200 million revenue target. Whether you choose to track this through the Robinhood app, place limit orders on your Interactive Brokers account, or analyze it through advanced tools on the Fidelity mobile app, Datavault AI remains a textbook example of an equity where the historical baggage completely masks the modern operational pivot, making it a critical watch for anyone interested in the intersecting lines of enterprise data infrastructure and global digital asset development. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.